On April 20th, 2025, a massive 145% tariff on Chinese imports brought U.S. ports to a sudden halt. Roughly $14 billion worth of cargo disappeared, leaving port terminals deserted and store shelves shockingly empty. The Port of Los Angeles resembles a ghost town, with retailers scrambling to manage shrinking inventories as quiet panic builds across the country. But this isn't just about shipping delays. It's a real threat to the nation's supply chain stability. Let's unpack the key moments in this economic standoff and what it means for ordinary Americans. The Port of Los Angeles, a major gateway for Pacific trade, has taken a serious hit. According to Executive Director Gene Soroka, cargo volumes could drop by 35% compared to last year. But this isn't a slowdown. It's more like a standstill. Major shipping companies like Maersk and Hapag-Lloyd are scaling back operations, canceling scheduled trips or rerouting vessels entirely. Over 80 sailings to the U.S. West Coast were canceled in April alone. And with more delays looming from China's own export terminals, containers are now piling up like abandoned carts at a supermarket. Some ships are skipping U.S. ports altogether, while others are stuck, waiting for direction. This isn't like the COVID-era delays caused by health measures. It's a deliberate policy-driven freeze that's stalling cranes, customs operations, and truck fleets across the board. Dock workers are getting fewer hours. Cranes that once moved containers non-stop now stand still. Even ports on the Gulf and East Coasts, which have a bit more variety in trading partners, are under strain, facing redirected cargo, customs delays, and lower volumes. The Northwest Seaport Alliance says incoming shipments are down by as much as 30%, with some exporters rushing to retrieve containers after having orders canceled. And with half of LA's cargo typically tied to China, the disruption is more than a ripple. It's a shockwave. What's stacking up at the ports is now vanishing from store shelves across the United States. The impact on retail is profound, and the economic ripple effects are far-reaching. Retailers throughout the United States are now under serious pressure as tariffs choke off imports from China. Companies like Walmart and Target, which heavily depend on Chinese goods, are seeing serious supply chain issues. The National Retail Federation forecasts that cargo volume at ports could drop by 20% during the second half of 2025. With shipments delayed or halted, many stores are burning through inventory fast, says Soroka. Most big retailers only have 5 to 7 weeks of inventory left. Shoppers may not find completely empty aisles, but they'll notice fewer product options and rising prices. Small businesses are taking the hardest hit. Jay Foreman, CEO of toy company Basic Fun, warns that if seasonal shipments don't arrive in time, especially for holidays, the goods can lose value overnight. Inventory management has turned into a risky juggling act. Retailers are considering new suppliers, but changing sources during a season is both expensive and slow. While the giant chains might ride out the storm, small retailers are stuck between higher costs and shrinking profit margins. Many shoppers already notice fewer choices in apparel, home items, and electronics. Prices are mostly stable, for now. But analysts say price hikes are coming if the standoff keeps going. This trade war is forcing U.S. retailers to rewrite their playbooks, and third quarter could be very turbulent. If you're finding this breakdown useful, don't forget to hit that subscribe button for more updates on global trade, shipping news, and economic shocks. Now let's move from store shelves to the bigger picture. The $14 billion cargo gap and steep tariffs are beginning to take a real toll on the overall U.S. economy. In the first quarter of 2025, U.S. GDP shrank by 0.3%. The first decline since 2020. It's a warning sign that the post-pandemic economic boost is fading. The transportation sector is one of the worst affected. West Coast ports have slowed down significantly, and both trucking routes and rail freight have seen a sharp drop in activity. Logistics companies are responding by cutting work hours, shrinking their fleets, and placing staff on furlough. If container shipments don't pick back up soon, the impact could spread to warehouses and retail centers, bringing more job cuts. Manufacturers, especially in the auto industry, are feeling the heat from rising costs for critical parts like electronics and interior modules. These rising costs are starting to show up in prices for consumers, pushing up inflation in durable goods. The uncertainty around tariffs is also making things worse. Businesses are putting their growth plans on hold, slowing hiring and slashing investments in new equipment. Confidence that had bounced back after COVID is starting to fall again. Inflation, frozen investments, and stalled trade are all weighing heavily on the economy. Even if the tariffs were lifted tomorrow, recovery would take months. Right now, the U.S. economy is on shaky ground. There's no quick fix, and many companies are being forced to rethink where they get their supplies. Supply chain shakeup and trade tensions. As shipping from China slows to a crawl, U.S. companies are urgently looking for new supply chain partners. Countries in Southeast Asia, like Vietnam, Thailand, and Indonesia, have become top picks. But replacing China isn't easy. Vietnam's factories are already over capacity, ports are jammed, and skilled workers are in short supply. Thailand is struggling with quality control issues due to the surge in demand. These countries simply don't have the refined efficiency or production scale that China developed over decades. Changing supply chains takes time and money. Fully switching suppliers, ensuring compliance, and arranging new shipping routes can take 1 to 2 years. In the meantime, companies are stuck with higher expenses, customs headaches, and shipping delays from limited cargo space. Some businesses in tech and automotive sectors are considering bringing production back to the United States, but high labor costs and government red tape make this a tough move. Domestic manufacturing only really works in high-margin or highly automated industries. For companies that depend on just-in-time logistics, even small delays can throw off entire production lines. While diversifying supply chains can make operations more resilient, it often sacrifices speed and cost-effectiveness. The shift away from China is happening, but it's far from smooth. And as companies scramble to adapt, the path forward for global trade remains uncertain. The trade relationship between the United States and China is stuck in limbo. Treasury Secretary Scott Bessent has said the current tariffs can't be sustained. Still, there's no clear breakthrough on the horizon. China has mostly stayed quiet, likely waiting to see if United States political or corporate pressure forces a change in policy. With both sides holding firm, the future of global trade looks anything but predictable. This ongoing gridlock has sparked what many economists now label structural volatility. Retailers are struggling to plan with confidence, while manufacturers are playing it safe, splitting their investments between two expensive strategies, one designed for long-term tariffs, the other in case those tariffs get lifted. As a result, capital investments are slowing, and research and development funds are being redirected into stockpiling goods and building up buffers against risk. Shoppers are already starting to feel the impact. There are fewer choices on store shelves, fewer seasonal product drops, and rising prices, especially in electronics, clothing, and furniture. Workers are feeling the pressure, too. Warehouse shifts are being cut back, hiring freezes are becoming more common, and if the instability drags on, layoffs could follow. Even more concerning, international partners are taking notice. If U.S. trade policy looks uncertain, countries might shift toward more stable partners, possibly turning to the European Union or Asia-Pacific regions. This trade standoff isn't just temporary. It has the potential to permanently alter global supply chains. And if negotiations break down, the United States could find itself on the sidelines of a system it once controlled. So what's the takeaway from all this turmoil? Conclusion: gears in motion. That $14 billion cargo freeze wasn't just a logistical hiccup. It triggered a massive disruption, echoing through U.S. ports, stores, and corporate offices. Idle cranes, missing shipments, and hesitant spending are now hallmarks of a new era where policy crashes into production as factories rethink their strategies, retailers brace for empty shelves, and supply chains begin to move away from China. Here's what's clear: the machinery of global trade is undergoing a serious shift. The decisions made today by both industry leaders and lawmakers will shape the next phase of global business and economic rivalry. Now it's over to you. Should the U.S. stick to its tariff stance or reopen dialogue with China? Can Southeast Asia realistically step in as the new factory of the world? Is bringing manufacturing back to the U.S. a wise strategy or just a pipe dream? Drop your thoughts in the comments. We want to hear from industry vets, weekend tinkerers, and curious viewers alike. Thanks for watching. Be sure to subscribe to 3 Daily News, your go-to hub for real-time auto news, market trends, and a front-row seat to what's coming next on the global highway. Check out the videos on screen. We've got plenty more ahead.